Okay guys, we're going to take a minute and just kind of talk a little bit about the difference between a wraparound mortgage and a subject to transaction, what they are, when to use them, when not to use them, pros and cons a little bit, and see where it leads us. If you find the video helpful, y'all, take a minute and like the video, please, and don't forget to subscribe to our YouTube channel. Make any comments below, and we'll be happy to respond to those as best we can. So subject to versus wraparound mortgages. So first off, a subject to transaction is where the buyer is buying the home, leaving the existing mortgage in place, taking title to the property, meaning they get a deed, and what we believe is giving the seller back a deed of trust for their security and protection. In this case, the buyer is agreeing to pay the seller's mortgage payment every month, but the seller is still liable on the debt. That means the buyer, the investor, oftentimes has no financial liability. They have what we call moral liability in the transaction, meaning they need to make that payment as they've agreed every month. In that regard, we want to make sure, as I said earlier, we give that seller back a security instrument, meaning the deed of trust per se, so that if for some reason we're unable to meet our obligations, they have a traditional mechanism to regain ownership of the property. Okay. Pretty simple. Now there's some little nuances you need to understand about a subject to deal, which is when you do that, you're usually going to pay the mortgage company direct. You need to make sure you navigate the back end of the transaction properly, that insurance is set up correctly where the seller and you as the buyer are named insureds on the policy. You want to make sure you go online, change any passwords, make sure you change addresses, phone numbers so that they can contact you in the event there's a payment change. They can email to you or mail to you the mortgage statement so you can make sure you're paying the proper amount in the event taxes, insurance, and things of that nature should change along the way. Now, a wraparound mortgage is where it's a new mortgage that you're signing. It's a new note in deed of trust. You are getting ownership of the property through a deed, but you're giving the seller back, in this scenario, a new note in deed of trust. That may be for the exact same terms and conditions of the underlying debt. It may be different. Oftentimes it is for more money, it's for a higher interest rate, and it may be for a shorter or longer term. And there's a time and place for all of this. If I'm buying a home that has an existing mortgage on it, would I prefer to buy it subject to the debt? Yes. If there's equity where I'm having to pay the seller either a lot of cash or maybe in the form of a second lien note, I would prefer that because I'm limiting my liability on that first lien mortgage. If I give the seller this second lien mortgage, I can make it a non-recourse loan, but oftentimes it is going to be a new note and a new deed of trust where we have liability, or at least our LLC has liability with that seller along the way. In those instances, of course, the same thing as a subject to deal applies, where I need to make sure I'm paying that first lien properly, but now I got to pay that second lien, because if I don't pay that second lien mortgage, the seller can obviously step in and foreclose on me. With the wraparound mortgage, it may be for a greater amount of money, but now I'm agreeing to pay the seller the entire amount. And the flow of money is really the differentiation between a wraparound mortgage and a subject to mortgage. A subject to mortgage typically implies that I, as the investor, I'm going to pay the mortgage company direct. A wraparound mortgage implies that I'm going to pay the seller direct, and the seller is going to pay the mortgage company direct. Now, why would I not want to do a wraparound mortgage where I'm giving the seller the option to pay the mortgage company? Well, how do I know that the seller is actually going to pay the mortgage company? So often we're dealing with distressed sellers along the way, and what we don't want to do is give money to a seller who is already in financial straits and have that money go down a black hole, never to be seen again. And so in today's world, of course, we utilize a loan servicer to collect that payment between with the wraparound to the seller, so that we know that the money is going to be paid to the mortgage company direct in advance, and any profit goes to the seller through from the loan servicer, so they get their profit along the way appropriately. Pretty easy in that instance. Now, sometimes the sellers don't have any objection to us taking the loan subject to. But if, as an attorney, I'm representing a seller, which doesn't happen often, I'm going to suggest a wraparound mortgage every time. It may be what we call a mirror wrap, same terms, conditions, great. But I do like the fact that I'm getting a new note deed of trust, which I think gives added protection to my seller versus a subject to type transaction. So if I'm the buyer, I want to do a subject to with a second. If there's going to be an equity spread in there. If I'm the seller, I want the wraparound. So it comes down to a negotiation between the parties as to when is the right time to do that. And every deal we negotiate as investors is a little bit different. Every seller we meet with is a little bit different. You're going to have a more sophisticated seller from time to time and a less sophisticated seller. If you get realtors or you get a lawyer involved, who knows what's going to happen at that point in time. But there are going to be some different constructs that they may want to implement. And again, under either scenario, make sure you understand what the rules and obligations are for your state. For instance, is there a property code issue, disclosure issues in that instance, a finance code issue you need to be thinking about? Is there a SAFE Act issue from a loan processing perspective, possibly, that you may need to think about? Now, if we're buying this home as a investment with a wraparound and it's a non-owner-occupied transaction, the great odds are we're not dealing with RESPA, the SAFE Act, Dodd-Frank, all those federal compliances, because it's an investment intent loan. So again, there's a time and place for both. Oftentimes, when we're buying the property, it depends on who our seller is and or what we can negotiate. Obviously, as the investor, I'm always going to try to negotiate the better deal for me. I'm going to try to negotiate the least risk for me along the way. But again, it's understanding that every situation may cause a different mechanism to be employed. And you just got to feel that out as you're negotiating with that seller each and every time. Now, does that prevent any back-end strategies from coming up one way or the other? No, it really doesn't at all. Oftentimes, also, if I've got a situation where my seller is in distress, they're looking for a way to get out, the great odds are I'm not doing a wraparound mortgage. I'm doing a subject to transaction because I'm having to bring cash to the table to close. I'm probably preventing a foreclosure from occurring. I'm bringing their loan current, helping their credit out. All types of things like that are ongoing at that point in time. And so giving them a wraparound mortgage may not be the way I want to go. And so that helps me negotiate that subject to deal versus that wraparound deal. Again, I've been in situations on higher end properties where we have more sophisticated sellers and buyers, and they want to employ that wraparound. Maybe the seller wants a balloon payment built in, meaning they don't want to give the buyer 30 years, 28 years, 25 years to pay off their loan, have it out there. They want that loan paid off, say, in 5 years, 3 years, 10 years, whatever it might be. And that's when you would employ the wraparound mortgage. Please keep in mind, you cannot change the terms and conditions of the existing underlying mortgage. I've seen a lot of investors think they can do that, can't do it. That's when you employ the wraparound mortgage for that purpose. Now, keep in mind, as I said earlier, we have limited liability with the subject to transaction. With the wraparound mortgage, you can make that a non-recourse wraparound mortgage, still offering the seller the advantages of a balloon vehicle and things of that nature along the way, which may also help you negotiate and navigate that deal to secure it. Because at the end of the day, the most important thing for us investors is to secure that transaction and buy the property so we can turn it into a profit. And every scenario, as I said again, is going to be different that you run across. There are some deals out there where, as I said earlier, if there's a large amount of equity, I'd prefer to do a subject to with a second lien versus the wraparound, but maybe you've got to negotiate it differently out there. So take the time, guys, understand what the differences are, how you need to negotiate this, how you need to protect yourself if you're going to do a wraparound mortgage with a seller in implementing a loan servicer into the transaction, just to ensure that all parties are protected. Don't let your money go down a dark hole someplace to a seller who may have financial issues along the way. And then employ the right vehicle to help you secure that transaction. So guys, I hope you found this video helpful. If you did, take a minute and like it. Don't forget to subscribe again to our YouTube channel. Make any comments below. We'll look forward to helping answer all those questions for you.